Welcome to the Armchair Trader podcast. This week, we are talking about the shipping industry, specifically about freight derivatives. On the program today, we have John Kartsonas, who is founder and managing partner at Breakwave Advisors. Breakwave is responsible for arguably the best performing ETF in the global ETF universe in the first half of this year, which has done spectacularly well and was up over 250% since the start of the year when I last looked at it. Welcome to the show, John. Firstly, I just wanted to see if you could give us a little bit more background on Breakwave Advisors, what you guys do specifically.
The idea behind it was that the shipping industry, which is one of the most important industries in the world, if you think about the global economy, was not really represented the way it should be in the global markets. And there are very valid reasons behind it, and we can discuss a little bit more later. But so we started the company in 2017. It took us about a year to put all the legal filings and face the regulators regarding BDRY. And in 2018, we basically launched the first and only ETF in the world that follows the shipping industry. During that time, obviously, the idea of creating a product that will follow shipping rates rather than equities was kind of quite revolutionary, I would say. It was very difficult to structure and model a product like that. So it took us a little bit longer than we expected. But since early 2018, BDRY is up and running. It has been running for 3 years now. I think that as a product, it has changed a lot the way that people think about ETFs, especially when you think what BDRY owns and what BDRY tracks. So it has been a very exciting period, a lot of, a very steep learning curve and a lot of new ideas and structure behind BDRY. But here we are with, obviously, as I said, an ETF that today tracks the shipping industry, the dry bulk shipping industry, the closest it can be. And it bypasses basically a lot of the intermediaries and a lot of the noise that equities provide.
And this is, for people who are not familiar with ETFs or exchange-traded funds, they are funds that are listed on a stock exchange and trade like a share, but they typically would be tracking an equity index. So for you to come up with one that's actually tracking the dry bulk market is fairly revolutionary and is giving investors access to a market that previously was something that really sort of specialized hedge funds used to have access to, but it wasn't as easy to get exposure to it previously. Could you give us a little bit more background on what shipping derivatives are and how the ETF gets exposure to that market?
The last decade has been all about disruption and cutting off the intermediaries and get basically the average investor closer to any product that's out there. And I think that's what we try to do with BDRY. So talking a little bit about the freight futures market, and I don't want to go too technical here because it doesn't really make a lot of sense. But as any other commodities market, there is a futures market for shipping. So if you want to take a view on where shipping rates are going, and basically a shipping rate is what you pay to transport a certain cargo from point A to point B. So there are thousands of routes around the world. There are like different cargos, but for dry bulk, there are basically, I would say, 3 main categories of cargos. One is iron ore, which is the main steel making component. The second is coal, the old coal that is used obviously for energy production, for electricity production. And then you have grains, which is food. I'm talking about corn, talking about wheat, soybeans, and so on. So these are the three main cargo categories in dry bulk. And every day you have like tens of cargoes being booked and shipped around the world. So if you are a shipper and you are concerned about what the future freight cost might be, there is a market out there, futures market, that allows you to hedge this exposure. This is very similar to what's happening with, let's say, the oil markets, right? I mean, oil traders trade oil futures either to speculate or to hedge their exposure. So this market, the call it the freight futures market, is a very esoteric market. Is basically dominated by industry people, industry companies that are using that to hedge or even speculate on the future level of freight rates. So for the average investor, this market was definitely out of reach. There is no screen you can trade freight futures. Obviously, is not available in any of the retail trading platforms, not even the institutional platforms. And if you think about hedge funds, as you mentioned, very few have the ability to, or the time, call it, or the appetite for risk to trade this market. So we thought that that would be something interesting for all investors, and to bring it to a simple, easy to use platform as an exchange traded fund. And now everyone can basically buy from one share to hundreds of thousands of shares, like you buy any other stock out there. And what the ETF, the exchange traded fund, does then, they go and through a certain very specific mechanism, they buy the underlying future. So instead of the investor having a futures account and trade futures, you basically trade as if you trade any other stock, and you have the same exposure in a much simpler product that you would have. And this is basically the case on a lot of other ETFs, not only BDRY that does that, but BDRY obviously provides access to a market that is not available in any different platform.
And as you say, it hasn't been something a lot of investors or traders have been aware of, but it is fundamentally one of the, something that we all rely on at the end of the day. We all somewhat take for granted the fact that these ships travel around the world, and there is pricing for an individual ship, that there is a cost to moving cargo, and effectively that's what this market is pricing. So the interesting thing then for us is what's happened now, what's different. I know there's been a lot of talk in the market about supply chains and the disruption caused by the global pandemic, and how that has disrupted the shipping market as well. Can you explain a little bit about the impact of the pandemic on the shipping market, and has that effectively caused a price squeeze somewhere in the futures market for shipping?
Just to give you a very general example of what shipping means for the global economy. About 90% of what is transported around the world is transported by ship. Whether you're looking at the bulk commodities, like I mentioned before, coal and grains, or electronics, furniture, clothes. Of course, when you talk about oil and gasoline and jet fuel, all these things are transported by ship. So it's a very important part of the global economy. And I think what is very interesting coming out of the pandemic is that initially you had a pause in the global economy. Let's say, in the second and third quarters of last year, as we know, there was no real activity, economic activity, and that means that transportation, like shipping, also saw a very slow period. Coming out of the pandemic, and I think like everybody can see it from their own experiences, people are much more open to spend, to buy, to rebuild, to refurbish, to eat, go out and eat. All these things in a regular cycle, they will happen gradually, right? So not everyone will come at the same time and decide to do something. However, coming out of such a major global event, suddenly you have, especially in the developed world, this urge to spend. And when we talk about spending, it's not only about buying stuff. It's about, let's say, the housing market. You want to, build houses. You want to, do a renovation, for example, in your house, or buy furniture. The same goes with like, food, going out to eat. The same goes with, driving. You're talking about oil demand. So all of this is happening at the same time. And suddenly the world globally is short of a lot of goods that now you have to either manufacture or ship from somewhere else. So that urgency, I think, to spend, and keep in mind that you have all this global stimulus that put a lot of liquidity into the market. So that's on top of basically the regular inventory cycle. Suddenly, everybody's looking for a ship to move goods, and especially on two categories. And this is the container ships. These are the ships that move the big boxes, and inside these boxes are a lot of consumer goods. And then dry bulk. This had a profound impact on rates, on actually the freight cost. On the container ships, rates are up tenfold. When, for the full decade prior to that, they didn't move much. I mean, they were up like 10 or 15% or down 10 or 15%. And suddenly you have a huge spike because there is not enough ships around the world currently. Overall, there are, but given the demand surge, there are not enough ships around the world to transport the goods that the developed world needs or, asks right now. So the same thing happened on dry bulk. And as I said before, dry bulk is concerned with like iron ore and coal and grains, but these are basically the ingredients that you need to produce the raw materials like steel. And obviously the energy, especially when it relates to China, to either produce or power their industrial complexes. The same thing goes with food, that for almost 9 months there was not a lot of inventory rebuilding, especially in terms of grains. So suddenly Asia is buying grains left and right, trying to rebuild their inventories. And all of this is happening at the same time. On top of that, you have a lot of delays in ports. You did have a lot of issues with COVID-19 and the crew on board the ships that caused a lot of delays. So the logistical chain it has been kind of a mess for the last 6 months. And whenever you have this type of events, the first thing that happens is pricing goes up. And obviously that's benefiting dry bulk. As you mentioned at the beginning, BDRY is up something like 250% for the year. And that reflects obviously the increase in freight costs, right? That's what BDRY tracks. So it does make sense as you look backwards. Obviously, if we're sitting here a year ago, it was difficult to predict this type of development because obviously you didn't know how the pandemic would progress and how the end will look like. But yeah, that's what's happening basically currently in shipping.
I guess from a conceptual point of view, I remember thinking there's got to be disruption to the shipping industry because by its very nature, the pandemic's going to do that. But at that time, it didn't occur to me that there could be a product as simple as an ETF that would allow an investor to take a view on that particular macroeconomic evolution. But going back to the actual pandemic itself, has there been any pressure on the dry bulk market that's been caused by periodic lockdowns? And I've heard rumors in the market that ships are in the wrong place, and there's a kind of cost for moving a ship that's actually currently empty to a port some distance away where it's required, and that's also playing a role in driving up the freight prices.
Yeah, it's exactly what you're saying. I mean, the cost that we're talking about is the cost to the consumer. That's the benefit to the shipping industry. Basically, if you don't have a ship or a ship is delayed in a certain port and you have to transport your good, then you're gonna look to find another ship and you will have to pay up for the ship to do the job. This is obviously a benefit to the shipping industry. It comes at a cost to the consumer, to the final end user. But keep in mind that in general, freight cost or the cost of shipping something, especially on bulk size, has been between, I would say, 10 and 30% of the value of the good, depending on what type of good you're moving. So, the increases look significant on the shipping side, but I think for the end user is not going to be as meaningful. At the same time, you had a significant rally in commodity prices. So I think the increase in commodity prices overshadowed the increase in on the shipping side, on the shipping cost. Like as I said, the most important commodity for dry bulk is iron ore, and iron ore has more than doubled in price in the last year. The price to transport iron ore also has doubled, but as a percentage of the final delivered cost is still around like 15%. So it hasn't really changed much the equation there. But again, it is all about supply and demand. So if a ship is delayed, then you need a ship. The demand is there. You don't have the supply. So in order to make that happen, price is what's going to have to move higher in order to for the equation to work. And I think that's what is happening today.
We're seeing, from our perspective, we're seeing a lot of commodity prices going up. It does look like we're moving into another commodity super cycle. Do you see, and this is not something that's going to go away, we don't think this is going to go away anytime soon. Do you see that providing further momentum to shipping prices?
This is like a very difficult thing to define, a super cycle. I think like the previous, the last super cycle, or the only one that people mention, would be the mid to late 2000s cycle in commodities. And that was driven purely by Chinese demand growth. And this time around, I don't think that you have the same ingredients for what's happening today in commodities. China indeed is the most important player when it comes to the commodities market, and demand from there has been, relatively strong. But I don't think that anyone can argue that this has been unusually strong. It has been strong on a very short period of time as well. In the last 6 months, you had China basically buying a lot of commodities, but it's not so much related to the pandemic. If you were to break it down sector by sector, you will see there are different drivers there. For example, take coal. Coal is obviously a very hated commodity, given all the green initiatives around the world. And coal has been in a steady decline for the last 4 or 5 years in terms of demand. However, for China, it remains a very important commodity when it comes to power generation. As we speak, China is facing energy shortages across their grid for various reasons. One has been that their domestic coal production has been curtailed because of various accidents. They're trying also to limit coal, or the dirtiest of the coals, in terms of usage. So suddenly, China is faced with not only summer shortages in terms of power, but potentially winter shortages. And obviously that's a national security issue for China. So now they're going to go out there and buy coal because they need that. So that's not really COVID-19 related. Then you take the grains issue, which China comes out of a significant domestic issue with food that came before the pandemic, and now they have to restock basically their inventories. So there are a lot of other drivers, I think, that contribute into what's happening in commodities. Obviously, inflation is a very important driver when it comes to the commodity cycle, and I think a lot of people are worried about that, and maybe they're restocking ahead of a potential, inflationary period over the next few years. That's obviously a bigger macro-related concept, which again, who knows how the future will look like in terms of inflation. But all of these drivers are very bullish, very positive for shipping, because it touches shipping in a lot of different areas, and it will potentially positively affect shipping, the demand side of shipping for a few years.
Depending on where you are in the world, in some parts of the world, the pandemic seems to be more under control than in other parts of the world. How long do you see this sort of disruption or premium on shipping prices continuing? I mean, there's obviously talk from certain quarters of the shipping industry about suddenly building new ships and creating more fleets to meet this demand, but you don't really build a brand new ship in a matter of weeks. So it strikes me, therefore, that if there are these pressures, they're not exactly going to go away overnight. Do you have any view or opinion on how long this will continue for?
So this is a very important point that you're raising here, and you're absolutely right. It takes about 2 years to build a new ship. But there is another significant driver here when it comes to building new ships. Obviously the world is trying to change in terms of emissions control, right? Emissions reduction. Shipping contributes about 3% of the global CO2 emissions today, and there are certain efforts made to obviously reduce that over the next decades to comply with the Paris Agreement. To that extent, the industry is pushing for changes in the technology of propulsion of ships. Like today, the ships, they burn heavy fuel, which is it's a significant pollutant, and they're trying now to find a new way, either with new fuels or by reducing the CO2 emissions on the existing fuels with technology in order to comply with the regulations. If you're a ship owner, even if you see today a very strong market, you're not really sure what exactly the type of ship you want to build, right? Do you want to build a ship that burns the heavy fuel, and you're stuck with the ship for the next 20 years that might be obsolete by 2030? Do you want to put an engine that burns, let's say, ethanol or hydrogen, which doesn't exist anyway? Even if you want to do that, there is no technology right now to do that. Or, there are various other technologies out there, but nothing has been actually been the chosen one, or none of these have been a proven one for shipping. So probably you don't want to build a ship that's going to be delivered 2 years from now with the old design, with the old engine that burns the heavy fuel, because again, there is a lot of push in the industry to change that. And that creates a very big hole in the order book that even if there is an incentive, the economic incentive to build a new ship today, because the returns are significant, you don't want to take this risk, because by the time the ship is delivered, the world might be totally different in terms of what the regulations look like for shipping. And I think that comes to, as we said about the demand, I think the demand for the next few years should be strong because of like the inflation and the commodity cycle and so on. Now you come to the supply side of shipping, and I think the supply side will also be very favorable for shipping, not only because it takes 2 years to build a ship, but no one wants to really put the order for a new ship because they don't know the fuel of the future. And before this is settled, you won't see a significant order book, meaning ships on order out there. Once this is settled, I expect, if rates are where they are, to have a rush of owners to build new ships, because again, the returns are significant, but we're really far away from that scenario.
To go into things from a slightly more technical perspective, obviously, if you look at like a plain vanilla ETF, that ETF is going to, say, track an index like the S&P 500, and a lot of passive ETFs track indexes published by a third party, usually an established or pre-designed index of stocks. Can you say a little bit about how you went about building the underlying for the ETF itself, what it actually in reality is tracking?
Absolutely. And I understand very well that shipping is not the mainstream industry, let alone freight futures. And that obviously can confuse or complicate investors with what BDRY does. Again, it is different in terms of like what it tries to achieve, BDRY. As you said, a lot of the ETFs track an index and provide investors with with the ability to invest in a specific theme or a specific group of stocks. And there are like thousands of these ETFs out there. BDRY, the purpose of BDRY is to provide access to investors in a new market. The idea is not to track any specific index or any specific, group of stocks. Obviously, it's not a stock ETF, but it's a futures ETF. The main purpose is to provide easy access to the freight futures market. Now, of course, there is a very specific methodology and of what BDRY holds, what it buys, and how it rolls the futures contracts. Keep in mind that futures expire every month, so you have to always maintain exposure to the futures market. It's not like equities that you can buy a stock and hold it forever. So there is a very specific methodology, which is very well described in our prospectuses and our documents. But in essence, BDRY holds futures with an average duration of 3 months forward at any given time. So what an investor gets exposure to is 3 months forward futures. And that's always has been consistent, will always be the same. And then it also has a mix of different sizes of ships, because ships come, there are bigger ships and a little bit smaller ships that move iron ore and coal, some other ships that move, as I said, grain. So there are a lot of different ships. It's not one category. So we have a mix of these ships that we think better represents the overall dry bulk market. And all this is maintained and well described in our documents. And obviously, the methodology that we have is to maintain this, the mix of ships and the mix of duration on the futures contract. So that's what is inside BDRY and what BDRY holds.
You picked the dry bulk market partly, I guess, because of its importance as a shipping market. Do you think that there's scope in the future for other ETFs on other subsets of the shipping market as well?
Obviously, we're looking at a lot of different opportunities all the time. And I think that the area that we have been focusing more lately is more on what I said before, the environmental changes that are coming into shipping. And some market analysts have been talking about amounts close to $4 trillion that are needed to basically change the global shipping industry. There are about 100,000 ships today out there that will need to comply with the new environmental regulations over the next few decades. And somebody has to provide the technology and the manufacturing and the new propulsion methods and technologies in order for this to happen. So we think that this is going to be something very interesting. It touches the shipping, but also it touches the technology aspect of shipping. And obviously there are other segments in shipping, like the oil tankers and the containers. It's a little bit more complicated there because the futures, they're not really, a liquid futures market. In the container market, in the tanker market, it's a little bit more complicated. But, again, what we want to do is basically provide investors with either difficult to access markets or add value through our knowledge and expertise in the shipping market. This is not about just putting a basket of stocks or a basket of futures together and just competing with the thousands of other ETFs there. Is to really add value to the product, either through our own research. Obviously, we do have a very strong team, have been around in shipping for many decades, and we can provide real value. We do that with BDRY today. I mean, with BDRY is not only that we provide the ETF, we provide significant support on the research side, and we post almost daily commentaries about what's happening in the dry bulk market. We post research and so on. The same thing we want to do basically on the environmental side of shipping, and really, help investors understand this industry, which I think in the US is definitely an underinvested market.
And the ETF is BDRY, I think is the ticker, and it's listed on New York Stock Exchange ARCA market.
Yes.
Do you have any plans to list similar vehicles in other sort of regional exchanges, say, for example, in Europe?
For the exchange traded funds, the US market is the deepest and the most liquid market. And I think that today most investors have access to the US markets anyway. Maybe there is some barriers for retail investors to trade in the US ETFs. For some reason, I'm not sure why there is such a barrier to entry. If investors will be free to invest in any market they want, and as long as they're regulated. But for now, I think we're going to stick with the US market. I do think that actually Europe is more knowledgeable in shipping than the US for various reasons. Has always been the center of trade in the world. But on the other hand, I think the US market is underestimating the importance of shipping in the global economy, and I think there is the opportunity here to actually grow and educate investors on shipping, something that is not obviously a new technology or a new industry. Is definitely an old industry, but it remains a very, very important part of the global economy. So we want to be leaders in that sector and educate and have a following on the shipping market.
No, I agree with you wholeheartedly there. I've always been very interested in this market, particularly when I was covering hedge funds that were active in it. But it's great to see a product like this coming out that gives investors that easy access to the dynamics of it, and also particularly doing so well in the first half of this year. It's been fantastic. Thank you very much indeed for coming on the show today. That's been really, really informative.
No, thank you very much for having me, and hope that we have more products in the future to discuss.
Brilliant. Thank you very much, John. You've been listening to the Armchair Trader podcast. To get up-to-date commentary on what's happening in the share markets, both in Europe and North America, and our views on some of the emerging investment stories in the small cap space, make sure you check out www.thearmchairtrader.com and sign up to our free daily newsletter.